Hello, this is Brandon Kaplan and Minging Li presenting our presentation called Evaluating the Efficacy of Statistical versus Simple Machine Learning Pairs Trading Strategies for you today.
Yeah, so here is our today's logistic for our presentation. First of all, we'll talk about like what is a kind of pair trading. Next, we will show like how we chose our assets and talk about our two algorithm for this project and have a kind of discussion and a detailed conclusion for the whole thing. And so what is a pair trading? Pair trading is an algorithm that buy and sell two correlated assets at the same time. The basic idea is to sell the overvalued asset and buy the undervalued asset. Therefore, this algorithm does not generate profit from market direction, but from the relative performance of those assets. So there are two benefits that we believe we can get from the pair trading, which is risk diversification and the reduced market risk. And here is our first algorithm construction process. We firstly established the model parameters and made appropriate assumptions if applicable. Next, we generate entry and exit signals. After that, we did backtest and evaluation for the tuning and the refining purpose. And specifically for the price difference, this algorithm simply computes the difference in price over a historical look-back period with normalization. And at each start trading day, we will have the new daily price difference, and we will normalize it and fit it into the historical look-back period. And here for the normalization, it means to evaluate relative to the look-back period's mean and standard deviation by the z-score. Next, Brandon will talk about the OLS algorithm.
So an overview for some of the logic behind the model that underlies our second strategy would be an introduction into ordinary least squares, which is a simple regression model. And this regression model is sometimes considered one of the most basic forms of machine learning. The idea here is to try to establish a relationship between an independent variable and a dependent variable by fitting a linear equation or a line that describes this data. So in that sense, the computer is learning from the data and then predicting a relationship. Each data point that the line will try to fit here has coordinates xi, yi, where xi is the independent variable value at time ti, and yi is the dependent variable at time ti. The idea here is to estimate the parameters of this line. So with just one independent variable, that's just a slope of that independent variable and the y-intercept. And we'll see here how that looks in terms of an equation. We see that here we have equation y equals something like a similar line, y equals mx plus b, where beta naught is that b and m is that b1. So y sub I here is a dependent variable. In the case of our presentation, that's going to be the price of the stock AMD, or advanced micro devices. The y-intercept for the model is going to be called beta naught. This is the parameter that the model will estimate. The model slope coefficient, beta 1 here, that's another parameter that the model will estimate. And here is our independent variable, x sub I. Over here, this epsilon, that's a random error term that's basically capturing how our model deviates from reality. Now, the way that the ordinary least squares model works is that it estimates these parameters by minimizing the sum of square errors, the SSE, and that's why it's called least squares. The square errors, it's really fitting a line to the data points such that the sum of the magnitudes, like those distances between each point in the line that is the relationship between them, is smallest as possible. And that line is just that learned relationship describing the linear equation that we showed in the last slide. So I can really plug in any value for x, and I'll get out a predicted value for y. Here we'll talk now about how we actually chose our assets.
Yes. After explaining the general process of constructing the algorithms, here's as Brendan mentioned, this is a process like how we chose the correlated assets. First, we treat the NVDA as the interested asset. then we compare with the similar companies like Apple, Microsoft, Tesla, and we found that AMD has the highest correlation with NVIDIA in returns over the listed time period. The reason that we chose this time period is because AMD and NVIDIA produces GPUs, and this aligns with the current AI boom trend, which contribute to the high returns for both companies and have a high correlation between companies. Also, for the next slide, we found the same thing in the open price correlation. And specifically, this is like how we implement the price difference model in the following ways. First of all, we think the price difference algorithm is a purely statistic model, and the rolling window approach looks at the historical price differences between the NVIDIA and AMD, and we determine the entry and exit signals by calculating the z-scores, and we also get the mean and the standard deviation of the window. And here are the parameters and assumptions that we use for the price difference algorithm. So the past window size is 30 trading days, and we just use a z-score as a threshold to managing with the exit and the entry signals. And the order volume is 50 shares for each stock. For example, we buy 500 shares for the NVIDIA, and then we sell 500 shares for AMD simultaneously. The reason that we use a share equal method in this algorithm is because the price difference is based on one NVIDIA share and one AMD share. To make things consistent, we use this justification. And for the order type, we just think this is a kind of market order, and there is no slippage and fees. And if there is no exit signals generated after 30 trading days, we will just close our position with the most available market price. And for the next slide, here is a kind of thing that how we determine the entry signals. So we basically compare the 31st day's open price to the previous window to find a signal to open our position. If the price difference z-score is greater than 1.5, which means we believe the AMD has been undervalued and the NVIDIA has been overvalued, so we buy AMD and sell NVIDIA, and we record the expected exit price spread using the z-score equals 1.49. And it's the same logic here. If the z-score is less than 1.3, we will sell AMD and buy NVIDIA. So, and we will also record the expected exit price spread using z-score equals 1.31. And if the z-score is in the between, we will do nothing for the entry signals. And for the exit signals, the logic is same. Like we compare the 31st day's open price to previous window to find the exit signals to close our position. If the position has been open for 30 trading days, we will close it at the 31st market open price. If we already have a position in buy AMD and sell NVIDIA, and the actual spread is less than or equal to the expected exit price, the expected price spread, we will sell AMD and buy NVIDIA to close our position. Similar thing, like if we already have the position in sell AMD and buy NVIDIA, and the actual spread for that position is greater than or equal to the expected exit price spread, we will buy AMD and sell NVIDIA to close. If no criteria matches, we will do nothing. And next, we will show our match plotter for this algorithm.
I'm gonna change the share so that we can see our pie chart.
Yep.
So here you can see.
Yeah. So basically,
the match plotter for the price difference strategy. And yeah, you can go ahead and explain what the rows mean.
Yeah, so for each row, like the A and B for the index, it just basically tells you what type of the order is. Like for A, it's just like buy AMD and sell NVIDIA. B is like sell AMD and buy NVIDIA. And here we can see the entry date, the entry AMD price, the entry NVIDIA's price, and the expected exit price difference for the trade. And we can see the actual AMD's exit price and the actual NVIDIA's exit price at what date and closed by which method. Like strategy means we successfully implement our algorithm if we find something called uh by the requirement, it means like it is over 30 days, so we just close with this rule. And we can go back, and thank you, Brandon. We can go back to the slide.
Switching back to screens now. Bear with us.
Yeah, on this screen, we show the kind of the graph of our trading signals for the mesh plotters. And next, this is here we show the characteristics of the price difference algorithm. And for our algorithm, we found that like the volatility of the returns is roughly 3.71%, and there are 92 round trip trade in the past years, and 92.39% of them has been closed by the strategy. Here, it means that it is that if it is not closed by the strategy, it is closed by the 30 trading days rule. And we found that the average return per round trip trade is 2.49%, and we have a very high maximum and a very low minimum, which are like 15.8% and negative 18.48% respectively. And the average length per round trip trade is 5.63 days, and the geometric mean rate of return per trade is 2.52%. And on the right side, here is a kind of the graph showing that if we have $1 million, here is like how the portfolio value change over time. And next, Brandon will talk about the details for our OLS algorithm.
Cool, so I'll go ahead and let's start with a quick overview of the second strategy, the OLS method. The idea here is really to synthesize linear regression with some hard-coded rule-based factors to make trading decisions algorithmically. And just like in the price difference model, the OLS model is going to utilize a rolling trading window that lags behind the trading day it predicts on. With each iteration, the window shifts 1 day forward and drops the oldest day's data so that the size stays consistent. OLS, which we explained earlier, is going to be used to fit a linear model to the training data, where the log price of NVIDIA is given as the independent variable, and the log price of AMD is the dependent variable, and we're interested in predicting that. So I mentioned log prices, and I'll explain why we use log prices further in our parameters and assumptions slide. Now, once the model is fit, the NVIDIA opening price for the current day, which is like real live data, is passed to our model to predict what our model thinks the price of AMD should be at open on that day. The actual opening price of AMD is then compared to the predicted price of AMD to calculate the spread between what our model predicts and reality. Now, what we do to do that is just take the actual opening price and subtract the predicted price to gather our spread. Then we are going to normalize that spread, which means basically that we convert it into a z-score, similar to the price difference model, just by subtracting the mean spread calculated over the window and dividing it by the standard deviation of spreads calculated over the training window as well. The normalized current day spread is then compared to what we're calling a non-dynamic threshold, meaning that the threshold is a hyperparameter that is not learned from the data, but we hard code in and like choose a number. And we'll explain that further in the parameters and assumptions slide as well. And whether or not the normalized spread is larger or less than the threshold is going to decide entry or exit from trades. So now I'm going to explain some of the parameters and assumptions for the OLS strategy. I'm going to start with the model parameters and model assumptions. These model parameters and assumptions are inherent to any OLS model, and these are actually learned from the data. They include the beta naught, which we discussed earlier as the first coefficient in our linear model. This corresponds to the y-intercept that the model learns from the data. We have beta 1, the second coefficient in our linear model, which corresponds to the slope of the line fit by our model to our data. And another intuitive way to think about this is that this beta 1 is the change in AMD's price for every unit change in NVIDIA's price. The degrees of freedom of the model, and that is how many parameters are being estimated from the data, excluding the intercept. So basically, how many predictors does my model have? And then we have the degrees of freedom of the residuals, or the errors. These are like the leftover information unexplained by the model. It's derived as the number of observations that we had that trained our model, which was 14, minus the number of estimated parameters, including the intercept. So that's 2. We have the parameter for the intercept and the parameter for the slope. So our residual degrees of freedom is 12. Now, for some major model assumptions, we've highlighted that the epsilons, aka the residuals, are the errors, if you remember from our original equation that describes the linear model. We have a term at the end that's called the random error term, that's epsilon. Now, we highlighted that these, and which can be thought as the differences between the observed values of AMD and the actual predicted values of AMD that the model believes AMD should take on when we give it a certain NVIDIA value. These are assumed to be independent through time. That is, the residuals from one window are not correlated with the residuals from another. Now, we're also going to assume homoscedasticity of the residuals and errors, meaning that their variance, how they vary across time, is assumed to be constant. These are pretty critical assumptions that underlie OLS. And in order for OLS to be somewhat useful or informative for decision-making, these need to be fulfilled. Next, we're going to talk about some of our model hyperparameters, and that is parameters defined outside the scope of our model that are not directly learned from the data, but which can be tuned via optimizing results through backtesting. Starting off, we have the size of our rolling window. In this case, we chose 14 days. We started this experiment using 63 trading days, or approximately 3 months worth of training data, but learned through backtesting that our model was overfitting to old data and making particularly unintelligent decisions regarding entry and exit. Now, over a series of trials, the window size was decreased from 3 months to 2 months to 1 month to 2 weeks before we settled on 2 weeks because it started, making decisions that we thought, led to better performance. Next, we have the entry threshold to compare against our normalized spread. Earlier, I mentioned that this was hard-coded, meaning that this number is not informed by the data. So we chose one and then looked at our performance and then updated based on that, sort of optimized it. The z-score for entry was chosen to be 2, so that the algorithm had to be extremely confident that it was witnessing a price anomaly that deviated from the norm, because 2 corresponds to 2 standard deviations. The z-score for exit was chosen to be 5% of the z-score for entry in order to ensure that the model was sensitive to any minute changes back towards the norm. Originally, we used 10%, but 5% was found to provide better model performance. The idea here was to make the entry and exit signals proportionally conservative so that smaller, more consistent gains might be made in order to prevent against any erratic behavior. Likewise, a stop loss threshold of -2% was chosen to protect against big losses on trades that were poor and were already losing money so that we stopped the loss before it got worse. Similarly to the windows, we chose -5% at first, and then -4%, -2% were tested as the model was still taking losses on certain trades that we deemed to be unacceptable. Finally, we have a total kill switch, which exits any trade after 30 days if no exit signal has occurred since entry. Similarly, this is just to protect against major losses. The last hyperparameters of the OLS model include the amount in dollars that we allocated to each trade. We followed as a baseline the 2% rule, where we only risked 2% of our account balance in each trade opportunity. So because our account balance was $1 million to start with each trade, we risked $20,000. And because the strategy was chosen to be dollar neutral, as there didn't appear to be a good reason to weight otherwise, like one-to-one weighting, we allocated 1% of our account balance to AMD and 1% to NVIDIA in each round trip trade. The order size was just proportional to the entry price for the asset, given 1% allocation towards each. So 10,000 divided by whatever the entry price for each asset was. For simplicity, we also assumed in this model that our market orders would fill out something close enough to the market open after generating a signal that the actual market open price for each asset would suffice for proof of concept. Consequently, we assumed zero slippage and zero fees just as well. Lastly, in the training, predicting, and computing of this spread with the OLS model, we use log prices, as I mentioned earlier, for NVIDIA and AMD. So these log prices are useful, especially for linear models, because prices are both at like different scales. NVIDIA is worth a lot more than AMD throughout most of the course of this experiment. So we normalize the price scales. We also use this to linearize nonlinear growth in the sense that the prices grow non-linearly, but when you convert them into log form, the relationship between, change over day is more linear. And likewise, we did this to have a better chance of the data being stationary and exhibiting homoscedasticity, meaning that the mean and the variance and the autocorrelation were constant throughout time. Now, likewise, we'll explain how we determine entry signals for this model. So first, the step is to just fit the OLS model on the NVIDIA and AMD, where NVIDIA is independent and AMD is dependent over the training window. Then once we fit our model, we call the model again and use the predict function of it to predict AMD's price on the first trading day after the training window by passing, as I mentioned earlier, NVIDIA's current trading price. Now we compute the spread between the actual and the predicted AMD price, and we normalize the spread based on the window's price mean and standard deviation. Now the logic works like this. Normalize the spread based on the windows. If the normalized spread, is greater than 2, this implies we're going to short AMD and buy NVIDIA via market order at the open prices. Now, if you think about this, when the normalized spread is greater than 2, this is really implying that the actual price of NVIDIA is greater than 2 standard deviations. The difference between the actual price of NVIDIA and the predicted price is greater than 2 standard deviations from what our model predicts. Since we assume our model is to understand the current norm to which the prices will revert, we consider AMD overvalued as it's 2 standard deviations above what our model predicts. So we're going to short AMD and buy NVIDIA because we're always shorting the overvalued stock with the anticipation that it goes back to a norm and buying the undervalued stock with the anticipation that it returns to a norm. Now the inverse is true when the normalized spread is less than -2, because it's just the reverse logic. For determining exit signals, our steps work similarly, except we have these other 2 conditions. One, that we have a stop loss. So while we're doing these signal generation every day, we're also computing the current value of the position and comparing it to the entry value of the position to determine net change. And if that percent change over the total entry value is less than or equal to -2%, then we say stop loss has been triggered. We don't want to take any more losses. Exit as soon as possible, which is at the market open price. Likewise, if the position has been open for 30 days with no signal, we just close at the market open. Now, the logic for generating the signal itself works similarly. Like if the normalized spread is less than or equal to 0.1, we buy to cover AMD and we sell NVIDIA. If we're in a position that corresponds to selling, originally shorting AMD and buying NVIDIA. Now, if the normalized spread is less than or equal to 0.1, the model is detecting that the difference between the actual price and the predicted price of AMD is less than or equal to 0.1 standard deviations from the norm, meaning we are quite sure that we have approached the norm after AMD had been overvalued. We're very close to where we originally thought it would be. Thus, we're going to buy to cover AMD and sell our stake in NVIDIA. And when the normalized spread is greater than or equal to -0.1, we have the inverse case just as well. And we would sell our long position in AMD and buy to cover NVIDIA. If no 3 of these things occur, then we really don't have any signal and we just do nothing. Now here is a look at the cash flows of both the NVIDIA positions, AMD positions, and the total strategy, which combines them over the course of the trade. So you can see it's a little bit erratic, but there's also linked in the description a HTML file that gives you an interactive view of this. Right now, I'll show the match plotter for this strategy. So bear with me while I switch windows again. So here you can see the matched plotter for the OLS strategy. Similarly, we have the index.
Hey, Brendan, I don't think we can see the match plotter on the screen for now.
Okay.
Yeah.
Oh, my bad. Thank you.
Yeah, here you go. Yeah, perfect.
All right. Now, similarly, you can see the index works the same as in the price difference, where we have A for, this time we have A for short and short AMD by NVIDIA, and B for by AMD short NVIDIA. But likewise, we have entry date, entry action, the entry price for both AMD and NVIDIA. And we have the exit date, the exit price for both of them, and the overall strategy return, which is just the log return. We calculated log returns for the stationary properties of the log in computing the geometric mean, which we'll talk about in the next slide. So this is just all the round trip trades, and there were 64 of them. So we have 64 rows here. All right, now I'll try to go back without messing up. All right, should be back now. Looks good. All right. Same thing here. We have the characteristics after backtesting the strategy. We took the same metrics for both so that we can have some sort of common ground, right? We can see that the OLS strategy was slightly less volatile than the price difference strategy in the absolute, but that it also had returns in order of magnitude smaller. As you can see, the average round trip trade return and geometric mean rate of return are both 0.2, whereas for the price difference, they were about 2%. Now its highs at 6.2 and its lows at negative 4.5 are also less erratic than the price difference strategy, which might be explained by the fact that, one, the constraints on the OLS strategy made it such that it made decisions way more conservatively. Like we had a very small exit signal, which meant that we had to be really tuned to something very close to the norm, and we had to have a very large entry signal, which meant we had to be very confident that we were away from the norm to exit in the first place. Now, we also had stop loss, which prevented against, taking on big losses on trades that the signal was incorrect on. So that might explain why our maximum and minimum are a bit smaller, and generally why our volatility is a little less. You can see that the average length per round trip trade was actually pretty similar at 5.67. But we also made like 2/3 the amount of trades in this strategy as we did in the price difference strategy over the same time period, with 64 compared to, I think, 92. So we were able to minimize losses, but we did also sacrifice gains here. Now you can see this is a similar graph as our hypothetical account balance over time. But the difference between this graph and the price difference graph that we showed earlier is that, look at the scale here. At the end, we were up, but we were only up about $3,000. Now we'll move on to discussion of the performance of each of these models in comparison to one another, using some metrics that are comparable across strategies.
Yeah, so here are the kind of metrics that we use. First of all, we can notice that the alpha and Sharpe ratio are both positive for both models, and specifically those values from the price difference algorithm are much higher than those from OLS algorithm. And specifically for both alphas, they are positive, indicating slightly outperform than the market for both models. And in terms of the beta, the price difference model is 4 times higher than that of the OLS, showing price difference algorithm is more strongly inversely correlated with the market compared to the OLS algorithm. Lastly, for the Sharpe ratio, considering their return and volatility that we shown before, the OLS Sharpe ratio indicate that even this algorithm has small risk, but the return is also low. This did not compensate it very well. And for the price difference algorithm with a higher risk, it generates higher returns, but still it does not get compensated well neither. So at that end, we believe both algorithm does not really have a good adjusted risk return ratio. And next, Brandon will talk about the summary for the OLS.
So this is going to help us get a sense of how the actual OLS model that the greater algorithm relied on fit the data on a given trade day. So here's an exemplar summary characteristics from an example fitted model. So we can see here that the R squared value is very low. 0.017 implies that only 1.7% of the variance in the dependent variable, which was the log price of AMD, is explained by the independent variable, the log price of NVIDIA. That suggests that we have a pretty weak model where the predictor does not explain much of the variation in the outcome, which was the predicted. The adjusted R squared is even lower and negative, suggesting that the model does not adequately fit the data and potentially could just be worse than a simple mean model that has no predictors, such as the price difference model. As we can see in our last slide, it did provide a better risk-adjusted return than the model with predictors. The constant coefficient, which was the coefficient beta naught for the y-intercept, has a p-value of 0.97, which is basically means that the intercept that we predicted is not statistically significant at the usual levels, which are tended to be accepted at less than or equal to 0.05. The slope coefficient has a p-value of 0.656, indicating that this predictor is completely not statistically significant. That's just as well. Lastly, we took a look at the Durbin-Watson tests for the presence of autocorrelation in the residuals for a regression model. So typically a value of 2 suggests no autocorrelation, and values substantially less than 2, such as 0.404 or 0.4, suggests that there is a possibility for positive autocorrelation. Now remember, autocorrelation in the residuals is meaning that the residuals are not independent and they are correlated across time periods. This is a violation of one of the fundamental assumptions of building a linear regression model. Since our result is much less than 2, we might have a problem with our initial assumptions in our model. Now, let's move on to some takeaways, key takeaways from this experiment. So our main conclusion is that the simple statistical mean model with no predictors outperforms the OLS model when risk adjusted. As we could see, its Sharpe ratio, which provides a metric of risk adjusted returns by taking the excess returns, the returns in excess of the risk-free rate for the strategy and taking that divided by the volatility of the strategy. So since the price difference model had a larger Sharpe ratio, we would say that it outperformed the OLS model in terms of risk-adjusted returns. While both of our strategies performed in excess of the market a little bit with greater than 0 alphas, they were sort of extremely small alphas that might, in combination with our Sharpe ratios being less than 1-to-1, might mean for a savvy investor that they would not use these strategies because the excess return is not worth the risk, even though the Sharpe ratio for the price difference model suggests that it performs better. So the takeaways are followed by that are that the OLS model just doesn't fit the data well, as we saw with our discussion in the OLS model summary, because there wasn't a good explanation of the variance in the dependent from the independent, which was NVIDIA, per our model. We have potential autocorrelation of the errors as suggested by the Durbin-Watson test, which might violate the fundamental assumption of linear regression. And we have potential heteroscedasticity of the errors as well, meaning that it's potential that the variance of these errors is also not constant. One of the things that we thought that might help explain this is that there are potential magnitude and scale issues in the actual change of these variables. So we normalize them with the log prices so that they would be closer together, but that doesn't really account for the growth of these prices as well. We also have potential to have confounding variables that the model doesn't account for, which would mean like we would need to have more predictors maybe. But at the same time, the simple statistical model just seemed to avoid overfitting to older data or patterns that were outdated. And that really ended up being more useful for us because we didn't make sort of unintelligent decisions when we had the absence of data. So now let's look at some future considerations and the rest of our conclusions. One thing to do would be to consider a logistic regression that might fit this data better if the relationship is not that linear and underlying, to build a binary classifier that characterizes something as an entry or not an entry and an exit or not an exit. We might consider a Riemann model or Markov chain Monte Carlo that would help to balance out assumptions that we made about our linear regression model that are not valid. So ARENA would take into account the fact that there might be autocorrelation. Markov chain Monte Carlo doesn't make the same assumptions regarding the residuals, so it might be more suitable. We also might choose to look at more granular data if we're trying to come up with a pattern. It might be that daily data over 2 weeks is too spread out. And if we want to make a decision at this moment, we need to look at, tickers by the hour or by the minute so that we can have a more short-term pattern that generates a strong signal. We might also choose to implement a dynamic threshold in the model so that the model is more wholly built around machine learning, which would mean that the threshold learns from the data such that it's like a percentile of the distribution of spreads over the training period instead of just a hard-coded cutoff of z-score. So if I say it's the 95th percentile of the spreads, then for each training period, there's a different threshold that's learned from the data. For now, though, the ultimate takeaway, it seems like, is that Occam's razor really wins. Occam's razor is a principle that recommends searching for explanations constructed with the smallest possible set of elements. And this is sometimes paraphrased as the simplest explanation is usually the best one. And in this case, with the price difference model, it certainly was. All right, thank you guys for listening to our presentation. And you can find all the code linked in the GitHub in the description, as well as some of the graphs used in the making of this model. Thank you.